Hey there, everyone. Happy Monday, December 2nd, and welcome to my weekly show on StockCharts TV. I'm Dave Keller, founder of Market Misbehavior and Sierra Alpha Research. Thanks so much for joining me here today. We're going to talk about interest rates. The 10-year yield has had quite a few reversals over the last 6 months or so. The 10-year yield got up to as much as 5%, came down below 4%, bottomed out in September, popped a bit higher into mid-November in the last couple weeks. 10-year yield coming right back down. Now, when you think about interest rates and their impact on equities or a portfolio of stocks or ETFs that you might be thinking about, the impact is nuanced, right? There are a lot of factors to consider. But what we want to do today is talk about the shape of the yield curve and how that is, often ways the most important piece of the interest rate puzzle, I would say, to understand, because that's where you can draw some direct impacts in terms of likelihood of a recession, in terms of recovery phases, expectations for future economic growth, and certain areas of the market, particularly in the financial sector, really you can draw their performance, in some ways almost directly to the shape of the yield curve. So we're going to talk today about the trends in the markets we're observing here in early December. Talk about the shape of the yield curve and how that's changed, how we now have a flat yield curve and what that means. And then we'll look at some of the charts that I think are very important looking forward, some of the ones to watch besides the shape of the yield curve to really understand the impact going forward. We're going to start here with the what I call the market trend model, just to sort of set the table for this meal we're going to have together for the next 20 minutes or so. And what I would say is, when you're talking about any sort of trend following approach, in December of 2024, at least for now, in early December of 2024, the trend is bullish, right? And that's not a subjective call. That's not an opinion. That's a fact, right? And that's a fact derived by many different trend following approaches. In my market trend model, it's a fairly simplistic trend following approach using weekly exponential moving averages as a way of defining the trend on multiple time frames. As a reminder, if you're unfamiliar with this general way of thinking about things, when we're looking at the weekly chart of the S&P, you see 4 exponential averages on there, 5, 13, 21, and 34 weeks. And I basically make a series of comparisons with those different moving averages using an indicator called PPO, the percent price oscillator. This is an indicator similar to MACD that literally will allow you to compare the values of 2 different exponential averages. You can include a signal line, which is how the MACD indicator really works, as you look at where it crosses up and down through the signal. Here I'm just eliminating the signal just so I can show the difference between those 2 exponential averages. So the difference between the 21 and 34 week exponential moving averages, I consider my long-term model, and you can see the other comparisons I'm making for medium-term and short-term. So the long-term model for me has been bullish for over a year and a half. It was actually late March, April of 2023 when the long-term model turned bullish, and it's remained bullish to this day. The medium-term model for me did turn briefly bearish in fall of 2023, but since late October through early December of 2024, the medium-term model has been bullish. So all of 2024 so far, it's been bullish. The short-term model has been a little more active, and that's kind of how it works, right? The short-term model just makes a simple comparison every week as to where we're at relative to the 5-week EMA. And for the last 6 weeks, we've been above that average, but we have had 4 different times in 2024, which are basically the major pullbacks that you see on the chart, where the short-term model did briefly, for a week or two at most, go below the zero line. So, overall for the last 6 weeks, essentially my market trend model has been bullish on all time frames, and that basically tells me to be thinking long and strong, to be focusing more on capital growth and capital preservation, while I will always share things I'm looking at that could be signs of potential top. From a trend following perspective, the trend is quite strong, right? And again, that's not an opinion of what may come next. That's just defining the trend in terms of analyzing the price action, right? We're at or near new all-time highs, and we can see that 2024 on this chart, and that's really the reason why I wanted to spend some time here first. Look how similar 2024 is to 2021 from a technical perspective. We have a very persistent uptrend. We have minimal drawdowns. The biggest drawdown in 2024 has been just under 10%. It was even less than that in 2021. We can see that the moving averages, for the most part, sloping higher. We can see that the market trend model on the long-term and medium-term timeframes have both been bullish for the entire year. The short-term model briefly went below in the case of 2021 5 different times or 6 different times. Here in 2024, only 4 times. So, very similar configuration. Now, from a fundamental perspective, 2 very different market environments. I mean, here in 2021, we weren't, wiping off our groceries. That was sort of this middle phase where it was unclear as to the causes and scope of this pandemic that we were all trying to understand and figure out as we're all working from home all of a sudden. By 2021, it was more the recovery phase, and all that stimulus that was injected into the economy was created a liquidity-driven bull market. As basically consumers were given a ton of extra money from the government to try and spend, try to avoid some climactically negative outcome. Now, some would argue that all of that liquidity that was injected in the system in 2021 probably contributed to the pain of 2022. That was sort of the hangover from that bull market off of the COVID low, and once the market started to give back some of its previous gains, we saw that the market indeed doesn't just go up forever. There can be some drawdowns that happen. And so for about a 10-month period from January through October of 2022, it was a significant downtrend. What concerns me now from a technical perspective are the similarities we see between 2024 and 2021. I actually covered that in a recent video here on the channel. But let's talk a little bit about how the framework of this market is different, because back here, the Fed was actually keeping rates incredibly low, and that was meant to spur spending, right? By keeping rates very, very low, by keeping yields fairly low, basically it was cheaper to borrow, it was cheaper to spend, and that was all meant to fuel consumer activity and to fuel economic growth, and really to stave off any sort of real negative outcome post COVID reality. In 2024, we have short-term rates that have gone up quite a bit, right? And so now that the short end of the curve is still quite high relative to recent years, still kind of low relative to some of the historical averages, but relatively high compared to the last 10 years. Now we have a yield curve that is inverted as opposed to a very normal shaped yield curve in 2021. What do we mean by that, by the shape of the yield curve? So StockCharts actually provides a free tool called the dynamic yield curve. If you go to StockCharts.com, click on charts and tools, in the bottom left corner of that thing, you're going to see what's called the dynamic yield curve. Now, this is a brilliant visualization. I've not seen anything like it on other websites, and I think it's just such a great way of understanding the relationship between the shape of the yield curve and risk assets like equities. Basically, to orient you to this chart, the bottom is just links to look at particular data points. If you want to look at the 10-year yield over time or something like that, that's an easy way to do it. But on the right side, we have the S&P 500. This is a weekly closing snapshot that's taken. You can see it goes back to the late 90s here on the left side of the chart. On the left half of this visualization is the yield curve. And so the way the yield curve works is you have bonds of different durations, right? You have short-term bonds, and we're showing the 3-month point as the shortest point here, all the way out to what's called the long bond, the 30-year bond. So the 3 months actually a treasury bill, 10-year or 7-year, you call it treasury note. The long bond, 20-year or 30-year, you call the bond. I don't know if that really matters, but that's what you call them. The Fed, just so you understand it, this is basically showing you, I'll come back to the Fed in a second, this is actually showing you the current interest rate, the current rate, the yield that these different maturities are paying, right? So the current long bond yield is currently paying a maturity right around here, around 4.5%. And we can see that the 3-month bill is currently a little bit above there. Now the Fed is actually off the left side of the chart. They tend to deal in discount rates, overnight rates, which are really short-term rates that banks are lending and borrowing from each other, borrowing from the government. It's really a very short-term interest rate that they are manipulating when they change the Fed target rate. But a lot of these other rates are all kind of derived. They're all derivatives of that sort of initial short-term rate. So on the short end of the curve, right, the very short-term durations, it's very much driven by the Federal Reserve, their target rate, and all the activities of banks lending and borrowing from each other. the further you go out in the curve, when you get out to the 10, 20, 30-year points, these are more driven by market forces. So the short end of the curve, right, the left side is really driven by the Fed and their expectations. The right side of the curve, the longer end of the curve, is really driven by investors, bond investors, and their expectations for future economic growth. Now, what we can do on the right side of the chart is actually click and drag back, and I'm going to go back to mid-2021 to show what's called a normal yield curve. Right? And let me maximize this a little bit here. All right, so when you look at a normal shape yield curve, what that means is the short-term rates are fairly low, certainly compared to the long-term rates. And that makes sense because if you're holding a bond for 10 or 20 or 30 years, you should be compensated, it would make sense logically, with a higher interest rate, right? You're locking up your money for a longer period of time. You should be compensated by having a better rate. And that really represents the expectations for future economic growth. When the economy is growing in a normal way, when conditions are optimistic, when bond investors are optimistic about future growth, they're happy locking up their money for a long period of time. They're happy, getting that benefit because, the expectations are pretty good. You can also either hit animate, which will put play and sort of watch this visualization over time, or you can just click and drag the yield curve. If you look at what happened sort of back in this period, really sort of went inverted in 2022 because all of a sudden bond investors got a little concerned about future economic growth. And all of a sudden we can see that the Fed was raising rates in the short term. And again, that's sort of off the left edge, but this 3-month rate is pretty close to that. To that Fed target rate. So all of a sudden we have this inverted rate, and the long end of the curve is much lower than the short end. That inverted yield curve represents pessimism about future economic growth, and as a result, the area of the yield curve that is driven by market forces is actually showing lack of optimism or pessimism from bond investors. Now, what happens is that inverted yield curve usually will happen just before kind of a painful period for stocks. As an example, you can see back here in like 2005, 2006, when we sort of got up to the eventual peak in 2007, we ended up having an inverted yield curve. And then all of a sudden the yield curve became normalized. Then look at how stocks sort of rolled over and really sold off in that period. The yield curve normalized as stocks were selling off. We can see the same thing wasn't as bad, but you can still see here in like mid-2000. Actually, was that bad. Now when I look at it, yield curve inverted in August of 2000. This was after the market peak had actually been registered in some cases. But you can see the yield curve was inverted. Then all of a sudden we become a little more normalized. And that's when stocks really had started to already sell off. So the inversion of the yield curve is a very forward-looking mechanism, sort of showing that there's lack of optimism. When the yield curve actually normalizes, that's usually when the equity markets start to sell off. A lot of people incorrectly think an inverted yield curve is bearish for stocks today. An inverted yield curve is actually bearish for stocks tomorrow because once the yield curve is normalized, that's usually when the equity markets start to get pretty painful. So this is what I have in mind, me and many other market strategists, when we see this inverted yield curve in 2023 and 2024, and all of a sudden we're seeing it maybe just start to normalize a little bit, and we remember our market history when that normalization of the yield curve usually leads to a pretty significant deterioration in risk assets. Now, you can see that the tool here, actually a couple quick features, and then we'll talk about some of the charts that I think you should watch going forward. Another quick feature is just that it's a simple thing, but there's a little word that'll be on the lower right corner of the yield curve visualization, and it'll either say normal in a normal sort of shaped yield curve. It'll say inverted if the short term is clearly higher than the longer term. What it's saying right now is flat. If the yield curve is if the yields are similar enough from the short end to the longer end, it'll just call a flat yield curve, which essentially means no real difference from the short end to the long term. Now, usually that is right before things start to normalize, and that's when equities are usually sold off as the yield curve is normalized, because what happens is as equities sell off, as economic growth becomes less likely, as investors start to get really nervous, and as equity investors sell off on risk assets, the Fed sort of lowers rates because they want to, limit the downturn. They want to minimize the chance of a full-blown recession. They want a soft landing as much as possible. And by lowering rates, they can spur economic spending or consumer spending. They can try to sort of set the stage for that next round of growth. And then all of a sudden, the yield curve is very normal with very low short-term rates and higher longer-term rates. As investors see that risk assets have sold off, all of a sudden they can see maybe signs for the next leg higher of economic growth, and that's when stocks will start to recover. Another thing, just a quick point, is if you want to compare like now to a previous time. So, for example, what does the yield curve look like right now compared to 2021? There's this button that says snapshot. Just click that. And then when you go to any other period, this is the current yield curve, and that's the snapshot I took. So that's the curve as of mid 2021. Here's the yield curve as of December 2024. So we can see that relationship in terms of the general level of rates, in terms of the shape of the curve and how that's different. It's a really good way to sort of take one historical period and compare it to other historical periods. Another thing you could do is look at where we're at now, hit a snapshot now, and then go back and look for previous times where we had, kind of a similar shape to the curve, and then think about what that might mean for, what could come next for equities. And again, this is not a predictive chart. This is no guarantee that, something exactly like before is going to happen. However, I have found it to be a really effective way of just thinking about market history, thinking about what different environments were like, recognizing and understanding how the broader macro environment could be different, but understanding it, right, and starting to ask questions about what that might mean for my portfolio. I want to share with you two other charts that I'm watching here to really sort of complete this thought process on the yield curve that is maybe more normalizing what that might mean. I do want to let you know that if you want to learn more about this sort of thinking about, looking at intermarket analysis, looking at trend following and trend following tools like my market trend model, I have a recommended reading list page on my website. It is free to access. I'd encourage you to check it out. If you go to marketmisbehavior.com and just click on reading list in the upper right, or go to marketmisbehavior.com/reading list, you can see some of the books that I've read that I've found really helpful when I think about what shaped me as an investor. It's books like these that have really helped me to do it. I've read all of these, and I stand by their value in terms of improving your own decision making, your understanding of yourself and the world around you as an investor. So make sure you check it out if you want to learn more about some of the tools and techniques and thought processes we're using in today's video. All right, so two charts that I will share with you besides the dynamic yield curve, and I would keep an eye on that really. And when I think about retail investors versus institutional investors, having worked with a lot of institutional investors, we would always look at the shape of the yield curve. We wouldn't really necessarily as much chart the 10-year point, although I'd know it and we look at it. For an institutional investor, it's really more about the shape of the yield curve because they understand what that tells us. And so working with bond money managers, bond fund managers, fixed income money managers, guys on our high yield desk, we would talk about the shape of the yield curve because it has that illustration really of a forward-looking expectation for economic growth, and we could then think about what that might mean for our equity positions today. So regional banks are often very closely tied to the shape of the yield curve. And if you think about sort of a smaller regional bank, it's kind of their business, right? Their business is borrowing in the short term from other financial institutions and then lending that out to you so you can, for a longer term period, so you can buy a house, buy a car, start a small business, do something like that, right? So their ability to make money is driven on their ability to borrow money at shorter interest or lower interest rates and lend money out at higher interest rates. And that's how they make money, basically on the shape of the yield curve. So an inverted yield curve isn't a great business model for regional banks. Luckily, that usually tends to be temporary. More often than not, the yield curve kind of has a normalish shape, which is why they're able to have pretty decent businesses most of the time. So the KRE is a regional bank ETF. A lot of the conversations I've had recently have touched on financials. I know with my podcast called Market Misbehavior, which you can find on my YouTube channel, called with that same name, Market Misbehavior. I know talking with Mark Newton recently, talking with Ari Wall, we actually talked about capital market stocks within the financial sector, and the yield curve and the shape of the yield curve was certainly part of that discussion, right? So regional banks, as I mentioned, a steeper yield curve. If the yield curve does become more normalized, while that can often mean some concerning developments for stocks, it usually means a much better environment for regional banks. From a technical perspective, the KRE is actually starting to improve quite a bit. you can see that the KRE gapped higher in early November and overall has really emerged from a consolidation period. I would probably label this an ascending triangle pattern or a coil pattern of some sort of consolidation pattern. We can see that resolve to the upside. We pulled back to an ascending 50-day moving average. Now we're making a clear pattern of higher highs and higher lows. What most impresses me is from mid-June to now early December, the KRE has outperformed the S&P 500. So if you think the yield curve is going to continue to normalize, if the Fed, is sort of at the beginning of this interest rate cut experience, this rate cut cycle, if the short-term rates come down and the yield curve starts to become more normalized, that should be a great tailwind for regional banks. As a reminder, I don't like to say something like the shape of the yield curve means regional banks will go up or will go down. It's not as direct of a relationship as you think. I like to think of it in terms of headwinds and tailwinds, right? So if the yield curve is flatter or inverted, that's a headwind, right? It makes it harder for regional banks to make money. If the yield curve is normalizing, it's going to be a tailwind. So the conditions that have not been as ideal for regional banks are starting to improve. I think that could fuel a nice period of outperformance. The financial sector is one of those areas of the market that's improving. Last week, in recent weeks, we did a video on sector rotation. We talked about the RRG and other visualization tools. Financials score quite well, I would say, at the moment, based on that methodology. So that's one of the areas that I'm certainly looking at. The other thing to think about, and this is more based on that macro theme that the yield curve becoming more normalized usually leads to the equity markets selling off. And we showed some of those examples of major peaks in the last 25 years, and that's certainly been the traditional relationship. So what could you use besides just the market trend model kind of thing, right? One of those charts that is just analyzing the trend of the S&P. Besides the S&P breaking down, what's something else you could look for that might indicate that the market is pricing in more of a chance of a recession than less of a chance? I would say looking at the relative performance of defensive sectors is a really good place to look, because if institutional investors see that steepening of the yield curve, if they start to think that chances of a market sell-off going into early 2025 are elevated, defensive sectors will start to improve, most likely. And the reason is because as an equity money manager, you usually can't rotate out of equities into like cash or something like that. You have to own equities. So it's just a question of what types of equities you want to own. And if you get nervous about the markets going lower, you get into defensive, low volatility, higher income paying stocks, which will give you a better opportunity to outperform if the market goes down. So defensive sectors like utilities, consumer staples, and real estate, these three lines, and these are all the relative performance of those sector ETFs versus the S&P 500. The direction of this relative strength could be an interesting indicator of a potential market sell-off, because if you see an improvement in these defensive sectors, that would imply that institutions or institutional investors are getting more defensive. They see risks for equities, and as a result, they want to go into lower volatility names. The idea being that if the market goes down 20% as measured by the S&P or the NASDAQ, defensive sectors with lower volatility and lower beta, lower risk, will probably go down a lot less than that. So you have the opportunity to outperform, just go down a lot less than the market when it sells off. So the utilities, consumer staples, and real estate sectors actually did start to improve as the month of November went on. Just in the last couple days here, coming out of the Thanksgiving holiday, we've seen a downtick in those relative strength lines. But I would certainly be watching this into the month of December to see if you see an improvement in these relative strength lines. And if so, that could mean that scenario we lined up about the yield curve becoming more normalized, rates the interest rate picture starting to change, recession likelihood increases, defensive sectors most likely start to do well, and that's when I would probably start thinking about getting quite defensive myself. That's sort of where I'm at in terms of the shape of the yield curve. This is how we can use the dynamic yield curve visualization to understand the shape of the curve and how it relates to previous market cycles. And I hope some of these charts like regional banks, defensive sectors could help you think about and assess a potential market reaction to that change in rates as we sort of queue up for the final Fed meeting of the year here about 2 weeks from this current week. As a reminder, if you want to track these market changes along with me, if you want me following the yield curve and understanding these different relationships, how they all line up, you probably want to check out my daily show called Chart This with Dave Keller. It's on my YouTube channel called Market Misbehavior. We also live stream on Twitter or X, on Facebook, on YouTube, and on LinkedIn. So I hope you'll follow me and my work there. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a great week.